Hey y'all, we're looking at Spyt, the Spyt ETF. Man, there's so many kinds of ETFs that I really haven't looked into, but a couple of people threw this one my way, and I looked at it a little bit, and I actually like it. I kind of wish I was in charge of naming some of these ETFs because you can come up with some really good stuff in 3 or 4 letters. But I love this because it's Spyt. Okay, Spyt, Spidey. Hey, there's another one. But if you haven't heard of Spyt, it's a income ETF. Okay, made by Defiance ETFs. I like that name too. And they're aiming to give you a distribution rate of about 20% annually, with a distribution frequency of monthly. Now, 20% divided by 12, whatever that might be, that's what they're targeting monthly. Okay. So basically, they're the S&P 500. The nice thing about it is that what they hold, here, we'll just read it. Our strategy revolves around holding shares of ETFs that track the S&P 500's performance and engaging in the selling of daily credit call spreads on the index. Now, if you don't know what a credit call spread is, we'll look at it real quick. I'm going to leave this link to Investopedia so you can learn up on credit spreads. But basically, this is what they're doing, not the bull put. They're selling the bear call spread. So they're selling a call. They're selling it lower than the buy. So they'll sell a call, say at 500, and they'll buy a call, say at 515. Now the strategy will give you limited loss because you're only limited to the spread, limited profit because you're only limited to the spread. Profitable conditions: neutral, bearish, moderately bearish. I think they're missing an E right there on moderately. It's funny how these educated people put these things together and miss letters, but that's okay. Basically what they want is for the index not to move very much, is basically what they're doing. Okay. And that's what they're saying here. They're selling a call option while simultaneously buying another call option at a higher strike price. By focusing on short-term options, we aim to offer an enhanced yield compared to traditional option-based strategies. Income generation: we sell at the money or near the money call spreads to retain upside growth potential and aim for a target annual income level of 20%. Now, when you do spread, I'll talk about this when we get down to their holdings. Each day, Spyt sells credit call spreads on the S&P 500. That would be the SPX, prioritizing options with near-term expiration. I hate this because they basically say the same thing in every freaking bullet point. One negative I have on it is it only has currently 17.42 million in net assets, but it's only been trading since March, so we're on 3 months now. Closing price right at about $20. Shares outstanding 875,000. Expense ratio is high, 0.94. That's typical. I mean, you got they're in there every single day, every trading day, trying to generate income. Performance, we'll talk about that at the end. Full holding. So the iShares S&P 500, ticker IVV, 96% of their assets is in that. So pretty good. So what's nice is, hey, they have 3%, almost 4% in cash. They'll need that cash to settle the option spreads because SPX is settled in cash. Oh, it's SPXW. I think that's the minis. So no shares will ever, their IVV position will never be called away. It's just cash settlement on the options. Now, how a credit spread works, if you look at this one is June 3rd at 5270. I don't think that's the mini, because 5270 is pretty high, I think. So they sold those and got $71,100. And then they bought these 5285s and spent 37,000. So we'll minus 37. So 71,000. They got that cash deposited in their account, and then they went and bought 30 of the 5285s at 37,350. So their net credit for the day is 33,750 bucks. Okay, and we divide that by 875,000 shares, and they get about roughly 4 cents per share. Okay, times that by what? 4 times 25 trading days, roughly $100 per share. Now, I think that's wrong. I think it was $1. I said 100. But they're paying out 32 cents. So with a credit spread, one of these is going to be a winner, one of them is going to be a loser, and they keep the difference, right? And that gets paid out to you. So distribution, 34 cents, 32 cents, 33 cents. Not too shabby. A lot of people ask, well, what about taxes? One thing I want to advise everybody, you'll see these 19A1 notices. They're called Section 19A1. Never, ever rely on whatever's in this. This is, I don't know who came up with this idea that they needed to put these out, but they're mandated to issue these Section 19As talking about what are the sources of the distributions paid, okay? So here on the current one, estimated net investment income, 19.29 cents. Estimated return of capital, 13 cents. Now, return of capital isn't always bad. It just depends on the whether the net, if it becomes out of the net asset value of the fund. But it's not always bad. It's really an accounting issue. Now, never rely on these, okay? Because this is showing currently 68% is return on capital. Return on capital is tax-free, basically. So this would be good in a taxable account if this ends up being true. They are mandated to put these out every month, but they are not mandated to be accurate. So whoever thought of this form is really, it's kind of like government. They just find ways to make things happen, and when there's no necessary, or it doesn't even need to be true, which is weird. But so that's the overview. Look at that. I'll share this down below so you can learn about credit spreads. We talked about sold call options provide inverse exposure to the full extent of any increases in the value experienced by the index minus the premium received. And then bought call options provide exposure to the full extent of any increases in the value experienced by the index above the option strike price. So essentially, the sold call option will lose money the higher the price of the index goes, and the bought call option will gain money the higher the index goes. So they don't buy these back. They just let them expire, and whatever is the difference there is their profit. So I already talked about that, and that's it. My favorite part about this one is that its performance so far. Now, if we look at the ETF channel, I already got Spyt up here, and we're going to track this. If you've never been on ETF channel, it's a good way to just track performance. And we're going to, since it's holding the S&P 500, I expect it to pretty much match the S&P 500. And we'll check that out right here. So we have Spyt with a total return of 2.74%, and then SPY with a total return of 2.76%. So really nice. It tracks the S&P pretty well. I don't know how it's going to do long term, what it's going to do in a crash or a run or whatever, but pretty impressive. Now, if you didn't reinvest the dividends, the performance is a little less than the SPY. Now you're saying, what's the difference here? Well, this one you're taking the dividends, rolling it right back into Spyt. This one you're taking the dividends and keeping it in cash. but it's still the investment value. They still count the dividend as an investment value. So it's not pulled out of it. It's just that's what your ending investment. If you spent the dividends would be 10,264. If you reinvested it, it'd be 10,274. So there you have it, Spyt. I like it. I think I'm gonna put a starting order in. I might start with 100 shares and just monitor it and see how it goes. But Spyt, check it out. Leave me a like, share, subscribe. I haven't done one of these ETF videos in a long time. I probably screwed up a whole bunch of stuff and whatever. It is what it is. Hope you enjoyed. Leave me a comment down below. We'll talk to you later. Thanks. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. Please seek a licensed professional for any investment, tax, or legal advice. Thank you.